Today's podcast, we're going to be talking to Scott Salo, author of Building a Sustainable Family Office. If you've been listening to podcasts for more than a year or two, you've probably heard of the 5 reasons why you should invest in real estate or financial planning, and it becomes the same stuff over and over again. Of course, check out my new book, The Wealth Elevator, which is more geared towards accredited investors and beyond. I like books because, as Scott would also say, guy puts a lot of effort into it, where podcasts sort of become lower quality, longer content. So I've been trying to search out specific topics that cater towards you guys. A lot of this is you guys are heading off into the direction, maybe not this generation, but the next generation of building your own family office. What came to my eyes was Building a Sustainable Office, which you can pick up his book on Amazon. We brought the author on to discuss some of the main topics here. And if you've never heard of a family office, maybe you may not be ready for it, but it's something to be aware of. I started to hear about this term when we started to buy large apartment buildings from these wealthy individuals. And we also, some actually started to invest alongside of us too. Before this, kid growing up in Hawaii, parents weren't accredited investors, didn't have an accredited investor, rich uncle. I didn't know any of this. Scott, thanks for jumping on with a bit of your backstory, professional background, and how you got into this world.
Absolutely. Thanks for having me, Lane. In our family, we had a family-controlled business. It was a manufacturing company, made medical and dental products. And that was something my father built for 30-some years. And then my brother came in and ran it the subsequent 30 years. I was the black sheep. I was always the entrepreneur looking to do something different. So I charted my own path, which started off by me going to work at Microsoft in the late 90s when the web was taking off, and moved to Silicon Valley shortly thereafter, and also continued on my journey in tech, more in the enterprise software. Throughout those years and experiences, I had exposure and involvement in a lot of startups. I was part of 7 founding teams. We also have a training and development company, given my training and development background, where we provide training to a lot of the entrepreneurs we work with, as well as investors. Among the investors that we started working with and seeing an opportunity to support were family offices. For those that may not be familiar, a family office typically refers to the infrastructure that a wealthy person or family unit will create to help them manage that wealth. As one accumulates wealth, they may start by parking that money with different money managers. At a certain point, it makes economic sense and you get better service if you can start building some of that capability in-house in your own controlled company. Some have 1 or 2 employees, some have 100 employees. It depends on not just the size of assets that the family office is managing, but the complexity and how the owners are using those assets. As a student of business, I find the whole space of family office business types very interesting. They're very unique. It's a very small number. The estimate is there's something on the order of 10,000 of these entities globally. They control about 6 trillion in assets, which is a staggering number. What's even more interesting is that number is supposed to 10x in the next couple of decades. For better or worse, you're talking about a lot of wealth that's very concentrated in a relatively small number of entities. In creating my book, we did a lot of research, interviewed dozens of family offices. Not all of them are as efficiently run as they could be. I suppose you could say that of most organization types. But it really becomes an issue, not just for the family members. Let's not forget, family offices are very interwoven with philanthropy. I've never met a family office that is not very philanthropically involved. The average family office gives about 11 million annually. They're very intertwined with startup businesses and new business formation. About $1 in $10 for every startup comes from a family office. As the health of a family office goes, so too is the broader society. And that's where I got very excited as it relates to our work at One World in trying to support these organizations to write a book about what I've experienced. I am indeed a member of a family office, so I have that inside perspective, but I also am very collaborative. And in creating the book, went to great lengths to interview dozens of others and hear what's working and what's not.
So I guess there's not really a strong definition. It's loose ranges, right? But if you can give your opinion on what are the net worth thresholds, or is it investable asset thresholds of the big institutional houses like your BlackRocks, KKRs, and then your family office, and then your high net worth, ultra high net worth?
Yeah, it's a good question. And it's not always correlated with money. There are people that have a net worth of $1 billion, whether that's liquid or in stock. and they choose not to create a family office, they just might park it with a traditional money manager. But by and large, thresholds might be around 100 million and up, where it starts to make sense to bring some of these capabilities in-house and start hiring your own people to do it. Certainly, an individual or family that may have $1 billion or more, it's probably 99% likely they have this infrastructure in-house or some of it, right? It's not really a binary thing. There's all sorts of hybrid models, if you will, where you might say, for these asset classes, I'm going to control them internally, hire my own team. That'll be my family office. But for other asset classes I'm perfectly happy letting other professionals run it. What I found, and I think some of the things that would be relevant for your audience, is these entities are tricky to run. The big headline is because they're unique businesses, they require a unique framework if you want them to be sustainable. And I use that word to really designate, are we building an entity that is built to last? Does this have some sort of longevity and sustainability to it as a business type? Will it be around? As it stands now, many family offices do not pass the test of time. And as they get passed from one generation to the next, they are deliberately dismantled or sometimes unintentionally dismantled. Some of these cases make it to the press and many don't. But again, where I come from, these are important organizations. And I think with some important changes in how the principals manage them, you could end up with a healthier ecosystem of investors. And I think that affects investors at all levels, not just the top of the pyramids. I'm hopeful that some of these lessons around how to manage the family office are relevant for asset owners of all sizes and all types.
To highlight something you said, there's a statistic that 90% of wealth leaves families in 2 to 3 generations. Unless you get serious about it, builds the infrastructure, which we're going to get a little bit more into. But that more money, more problems, as they would say in the old rap songs of the 90s that we're not supposed to listen to anymore, apparently. Thus creates, it gets complicated, right? And you start to run into multiple layers of offspring, cousins, all entitled off of this trust. But maybe let's start off with, just to give people an idea, maybe it's nothing in their generation that they're going to implement, but maybe talk about org structure. How do you get this started? From my point of view, the first time I started to see this, we would buy properties from wealthy people, and I didn't realize how much money they had. We'd get passed off to their multifamily underwriting guy. I'm like, okay, it's interesting, makes sense. But yeah, maybe just give us a high level on org charts and setup.
The organization structure, I think of it in context of really 5 key points. The first is the mindset that the principal has around this capital. What's the purpose of this capital? How am I to use it? Is it to create new businesses? Is it to just park it and watch it grow for 20, 30 years? How involved do I as a principal want to be? I think whether you have $1 million or $1 billion, these are important questions to ask. Morgan Housel's book, The Psychology of Money, makes a really important point. I think it's relevant to every investor, which is making money and keeping money are 2 very different things, and they require different skill sets. So if you're a hustler, if you're an entrepreneur, if you made money in real estate or early stage investing, or you ran a few operating companies, to then say, okay, I'm also going to be really good at managing liquid assets and thinking about asset allocation and choosing managers and what kind of funds I want to be in. Maybe it's possible, but coming to the challenge at hand with some humility to say, what's my role going to be? What am I good at as an investor? What am I not good at? The second part, I think that's really important, is having a purpose around it. Again, whether it's $1 million or $1 billion, what is this money for? Is this to propel one's career, or is it to start providing some joy for the family members? Or is it to pass on something to my kids? I think these are really critical questions to ask early on, because that will structure the third element that really influences what do you build, right? I liken it to building a house. You can build a 1,000-foot home that's designed to do XYZ for 1 or 2 participants, inhabitants. You can choose to build a $20,000 castle that's designed for 20 different people to live in. The structure is very much dependent on those first 2 things. And number 2, what's the purpose of the money? What am I really trying to achieve? But to get into structure a little bit, some of the details, there are many different ways that family offices are structured. As I alluded to earlier, sometimes the principals will choose to insource everything, which is to say, when it comes to the asset management and the investing component. They have all the asset classes managed internally. They're thinking about an overarching asset allocation model, then they're choosing specific managers. In the bigger offices, sometimes those managers or the fund managers are also part of the infrastructure. The asset management, especially liquid part of it, it can be enormous or it could also be very teeny, where there's one person overseeing the capital that's spread in many different third party, as you allude to, Lane, MFOs that are managing capital on behalf of many different families. There's other functions that may or may not be part of that org structure. So legal, trusts and estates, estate planning, those are some core functions that, every wealthy individual or family is involved in. The question becomes, is there enough activity that justifies bringing that in-house? Or are you best served by just finding the specialty provider, legal partner out there, and that's sufficient? It doesn't need to be an in-house function. A lot of family offices, even the smaller ones, are realizing that one of the biggest threats to the longevity of their capital is cyber threats. A lot of the smaller investors, smaller family offices don't have the infrastructure that the bigger entities do. So they're even more at risk. They're starting to bring in specialists, or they may have a fractional chief security officer. Let me stop there, Lane.
So correct me if I'm wrong, but just taking notes here, you've got the patriarch, which is the leader, and eventually many offspring and beneficiaries. But you mentioned the legal guy, possibly like a fractional legal officer or a legal firm that's on staff or paid on salary in-house, the tax guy. What I key in on a lot, we work with a lot of, they're not necessarily family office, but in our world, they're called debt funds, like more semi-institutional investors on the 10 to $100 million scale, where they are ran as a sort of, on the outside, they look like a private company, but
Okay.
on the inside, very much a couple of experienced mom and pop investors. And they will outsource a chief investment officer and some junior staff that are underwriters. So that's more focus in like multifamily or real estate world. But it's like you mentioned MFO multifamily office. In a way, that's what we've developed ourselves into, right? Trying to find the experts in a certain niche. And then we team up for that certain asset class, whether it's multifamily, venture capital. And that's one of the ways we've morphed into.
Which makes sense. Even if one has unlimited budget to pay for an internal team, sometimes you get better quality by going to the specialists. It's a good thing that they have other clients and can take that knowledge and apply it to your situation. Interestingly, I think at one point in time, it might have been only for the uber wealthy that were actually creating their own single family office. We're seeing some instances where some of the very wealthiest families are moving back from a single family office toward an MFO. They realize they don't need to. It's probably more cost effective not to have it in some ways. So that's a really interesting dynamic too. It's not always that more money means you just create it all yourself. Sometimes it makes a ton of sense to go to the specialists.
Yeah, part of the industry wide things, these services, these vendors are becoming more a little bit more standardized, so that option is there as opposed to going around your network and finding and hunting the one guy to bring on your team.
I think that's true. I would also say that as it relates to finding partners to work with, whether it's in the family office world, it tends to be there's three main ones, if you will. One is the investing one, the RIA. The second would be your legal trust estate. And then the third would be accounting and tax. So those are the three. If you were to suddenly find yourself in a place where you had a lot of assets to manage, I think those are the three areas of expertise that you probably want to find someone sooner than later. And also people that work well with others, because you probably won't want to bring all those functions in right from the get-go.
Yeah. People talk about building your team. And I think whether you're a net worth $1 million, $2 million investor, in a way you already have your team, but maybe the distinction is the quality of these vendors. If you're under $10 million net worth, certainly under five, you might be at Morgan Stanley, Chase, but you're not getting that top tier talent. You're getting what's for the masses.
I do see that happening. And I guess my observation and recommendation might be find partners that are very comfortable working with you in your situation. And if you have 10 million to invest and you talk to an RIA and their median client is 100 million, it's probably not going to be a good fit. By the same token, if you're going to be the outlier because most of their clients are bringing 500,000, 1 million, I don't think that's good either. So I think you want to go to somewhere where, and it's not just about the AUM or net worth kind of figure. I think there's other elements, but you want to go where there's other clients that look like you. And I think that's a key piece.
So maybe let's give some advice for folks that are stepping up to the 8-figure range, right? As they say, when you're a little solopreneur, the best thing to do is get that first VA. When you're stepping up to 8 figures and above, what would be the first hire? Or maybe it's more of a task.
I think there's two big concepts here. This pretty much applies wherever you may be on the wealth scale. The first one I would probably say is know what your lane is. What is your swim lane? What role are you going to play? You made money, and that's fantastic, but it doesn't mean that you're great at every single thing that's out there. And if you made money in a way that wasn't, let's say, managing money, that you weren't a wealth advisor, or you weren't an investor, maybe you're an operator, know what your lane is. Are you going to be managing the managers or are you going to try to do this directly? The asset allocation is fundamental. Most investors would say that's 90% of what drives return. And then there's also the manager selection. Who are the people delivering on the different strategies that you put in place? And so if your lane is to be, look, I'm going to be the board member here, I'm going to oversee that process. I'm going to hire a person or a firm to do those different tasks, be really good at that job, study up and learn from others. If you think you're going to be the one actually implementing these strategies, both coming up with the asset allocation and also maybe running some of this, okay, I'm going to take care of the privates, the liquid stuff, I'm going to turn that over to whomever. Really hold yourself to what are the skills I need to be really good at that job. And the other thing I would say is once you know what your lane is and define your lane, stay in your lane. I think where a lot of people get in trouble is maybe they'll have some early success in one of the activities that they're involved in. And they start saying, oh, I can do all this. I don't need this partner here or that firm there. I've been really successful with alternative investments. I'm going to start doing the liquid stuff. Not to be discouraging, but if you've created this wealth through some other business that had nothing to do with managing money and investing, you have to be a really rare individual that's going to catch lightning in a bottle twice and be as awesome as you are, as awesome as you were as an operator, the wealth creator. And then you're going to be awesome again as an investor. So surround yourself with good people that are conflicted, that don't make money, whether they send you here or there. Just good advisors, good sounding boards. These executive networks, we were talking about Vistage, that's one I hear a lot. And there's others, the YPOs of the world, great places to meet other successful individuals that can be unbiased to you. And again, know what your lane is and stay in your lane.
It's the people component, right? Tiger 21 is a good one for those over what I think 20 million is a threshold. Vistage, I'm in Vistage. You need to have a revenue of 1 million, 2 million or above a year. And then YPO and EO, I think is similar. But there's thresholds to get into these types of organizations. Thus, the people who are there have higher net worths and you start to get into these types of dialogues on the family office level. It's maybe 2 generations, maybe 3 removed from the original operator who started the business.
It's really interesting. Often the networks I am part of a few different networks. Some are traditional, more East Coast heavy firms, and sometimes that's a couple generations. But I'm also here in the Bay Area, and there's a lot of first generation wealth and tech wealth. And so it's really interesting for me to see the 3rd and 4th generation family office principal, how they think about things, and contrast that to a great tech inventor who is managing ungodly amounts of capital and trying to figure that out. There's a spectrum. But your point around these types of networks, those are all great networks. I love these family office networks. I'm fortunate I can afford to do that and spend the time and the money. It's a great investment. You don't have to be in these types of networks if you don't have the money for that, or if you just don't feel that's how you want to roll. But you still, of course, can have the opportunity to meet people wherever you may be living, out in the community, out in different business circles, and find people that you can trust that aren't trying to make money off you. And you can just be like, hey, I have an investment question I want to talk to you about. Can we grab lunch and go through this? I think that's really important to find good sounding boards.
Maybe like any principles that you've seen family offices emulate that the average accredited investor should just be aware of and maybe pivot to that from a mindset
Yeah.
perspective.
I think this notion of knowing your lane and then staying in your lane, those are really important. The other things that we talk about, just going back to the model I created out of the book, and we talked a little bit about talent and the importance of knowing what skills you as a wealth owner need to have and being thoughtful about that, right? Like in any company that's more than, let's say, 20, 30 people, you're going to start having defined roles. You're going to start having job specs. You're going to start being very specific around, okay, for this role, it's an operations manager, it's a sales executive. These are the skills this person needs to be successful. So apply some of that same thinking and process on yourself, on whoever else is there with you managing the money you have access to or that you've created. Think about, again, what do I need to be good at? Do I need to be good at building teams of people and finding expertise on the outside? Do I want to bring some of this inside? And if so, that's a different skill set as a manager I need to have. How do I read through what a financial advisor may be telling me? I know they're always trying to paint a rosy story and telling me everything's great, but do I know how to ask the right kind of questions to pierce through that? It's being methodical about talent and thinking about the right talent to manage the capital you have. And then I guess the last point, I think this applies to all investors, is that flexibility. Whether you're building a family office or you're building a first time some infrastructure to manage some capital that's been created out of a family controlled business, we're in a very dynamic period in history where change is the only constant. The pace of change is actually accelerating. I'm a little bit biased where I sit, of course. AI and the power of AI. Now, I'm sure there's a lot of hype out there about how it's going to change the world and so forth. But I am seeing pretty dramatically how it's making its way already. I feel like we're in the first half inning here in a lot of different industries. What does that actually mean to everything, right? The way society gets educated. I have young kids. I see how they're using AI already in middle school, which is pretty mind blowing to me. I think about healthcare and drug discovery. It's pretty fascinating how it's already being applied in some of those circles to the broader areas of the economy. And so I think the pace of all this will continue. And I think as an investor, we need to be really flexible, nimble. Don't build structures. Maybe a generation ago, when it comes to a family office or building infrastructure to manage the first 5 or so million an entrepreneur creates, you would do that with an eye toward sustainability and longevity. To achieve sustainability, I think you need to build in flexibility. Big buildings are designed to sway. If they don't, they will crack. Same sort of concept. Like, great to be building for the long term and thinking of the long term, constantly taking the temperature of what skills do I have, other people that I'm bringing in and working with. You might think, oh, geez, I created some money. I want to hire someone, JP, and just let it sit. And I'll look at it in 5 and 10 years. A generation ago, that was probably the right mindset and time frame. In today's world, that's a bit outdated, right? I would go do your diligence, hire JP Morgan if that's the one you want to hire. But by the same token, probably after 6 or 12 months, I would start saying, okay, what's my backup plan? How quickly could I maneuver to another firm if I had to? Do I have another candidate or two in the wings? It's being very flexible. And I think that's reflective of how society works these days.
Yeah, things just change a lot more quickly today. I was just recalling a recent conversation I had. Guy had $5 million of annual revenue, and they're doing well financially. Then the ending half of their kind of business career, but their attitude was, if we want to keep surviving, or what was sustainable, is we just have to keep powering forward. Because the way I see it, AI empowers the bottom and removes those barriers. It used to be you had to go to a good computer science engineering school to code. Now there's no code things. So there's lower barriers to entry, just like how the internet took away a lot of barriers to entry to start a business. So I think that long term, it's going to be easier for those who aren't as advantaged as a family office or somebody who sends their kid to college. And it's going to lower those barriers. And you just ultimately got to just keep kicking it in the ass and work harder. I think everybody.
I think that's right. I do think it creates a lot of opportunity and forces all of us to be even more and staying on track. And as the world continues to develop and specialize, I go back to one of my earlier points: know what your lane is. Don't get seduced into some adjacent area. You're bored and you're just trying to take on the new thing. Know what you're good at. get really good at that. Maybe then in time find a logical place to extend to, but do so very carefully and thoughtfully.
I'd like to switch gears a
Yeah.
little bit from the money side. A lot of this, as we said, is keeping it, not necessarily growing it. A lot of us have kids, the wealth succession planning. Something that I've never really heard is a lot of these guys will hire consultants. This is why in our mastermind retreats, I try and structure different groups or table topics surrounding that. But what are you seeing a lot of these family offices do to incorporate that, bringing in consultants, or what other methods are they doing to do this other than just talking about it at the dinner table, incorporating them into the landscape of, hey, we own all this.
Mm.
I've also heard at a certain age, they'll bring their kids in and have their entity diagram with all the LLCs, all the trusts, and says, hey, Simba, this is all you own right now. This is the land of the Serengeti that you're going to take over one of these days.
That's sometimes referred to as the reveal. There's a variety of ways to do it. I have my thoughts on what I think is most effective. I can share some of that. But absolutely, there's a variety of ways to introduce the next gen.
What's your opinion? Maybe give us the one that you don't think is as good. If you had to do it, how would you do
Well,
it?
here's what I've observed. Historically, my parents' generation, wealth was largely hidden from the kids. The fear was they're not capable enough to manage it. I don't want them to be spoiled. I don't want them to dither away this family capital, this family asset. So I'm going to hide it from the kids. And at the very last moment, when I really can't avoid it anymore, then maybe I'll start talking about it. I think a lot of families have taken that approach. Their intention was good. They didn't want the kids to become spoiled and not motivated to seek out their own success in life. But I think that approach by and large backfires. That kind of creates this culture where the parties aren't leaning in. If anything, they're leaning out between the older generation and younger generation. What I've seen, first off, if you don't give people information, they will create it themselves, especially kids and even younger, could be high school, college. They're going to figure it out. Anyone can go to Zillow and see what a home is worth. They understand how people travel.
Empathetically, like the silent generation, the baby boomers, low autonomy, that made sense.
My father was born in the 1930s in the middle of the Depression. For him, having money was a very novel thing. And he didn't know for how long it'd be around. So the idea of, okay, this capital is going to last for generations and I need to prepare that was like, what? Maybe it will, maybe it won't. What I would say is what I'm seeing as a more current practice, maybe a more progressive practice is at the right stages, invite the younger generation into the conversation. Some are going to want to lean into that conversation more than others. That's okay. I think it needs to be framed appropriately. And this gets to, again, whether it's a million or a billion, what's the purpose of the capital? For those that have the ownership of it, what do they want to do with it? Sometimes you don't. It's worth some time thinking through. And by the way, your answer can change. And no judgment if your answer is, I created $3 million through a business and working my ass off. I want to enjoy it. Okay. This isn't about some legacy or putting my name on a building. I want to have fun. I want to have a vacation home. I want my kids to put their kids through college and not worry about any answer is good. But going through the process of saying, I've thought it through and I have an idea what I want this wealth to do. Back to the conversation or the reveal with the kids, then I think it becomes a conversation. This wealth has been created. I'm going to reveal some of the facts to you now, more when you're 30, more when you're 40, what have you. That's for the principal to choose. But the point is, often when one goes through the process of saying, what's the purpose of this capital? They will inevitably say some of it's for our pure enjoyment. We're going to live off it. We're going to consume it. It's not going to be invested. It won't be there in the future. You're going to enjoy it. Some portion will be designated for a greater good. Maybe that's 5% or whatever it is, or they say some percent, or when I die, some percent is going to go to philanthropy or a family foundation. But the point is, now at least you've started the conversation and you've invited the kids into looking at not just an asset, but how that asset's going to be used in time. You've also opened the door to conversations to say, are you interested in managing this asset in whole or in part, in a part-time capacity, in a full-time capacity? You're not business inclined, you're more in social services. Maybe you want to be involved in the foundation part of this all, and the part of this which is giving it away. And we need someone in the family that's going to raise their hand and be charged of family philanthropy. Or you show a lot of interest in entrepreneurship. Maybe you would like to lead a family powered seed fund that we'd like to create. So all I'm saying is with proper thought around what might this capital go to in the future, that starts opening the conversation to some practical ideas of how the next gen can not only say, okay, I get it, dad or mom, we have this money, fine, I'm just going to live my life. But hey, maybe there's ways for you to be involved in managing it alongside us. The kids may say no, thanks for the opportunity, but I want to be a health worker. I want to be an artist. I want to be a rapper, whatever it is, fine. But at least you've created an opportunity to integrate the capital into their life.
In the Keystone conversation I've had dozens of times is like, we're going to fly first class this time. If I'm listening to what you're saying, I should probably tell little Johnny, yeah, we're flying first class because daddy worked and wants to fly first class. You're just along for the ride. And by the way, if you work hard too and you get passive income, you also can enjoy this lifestyle yourself. And maybe that's 9-year-old is pretty smart, probably understand that, but that's just a series of hundreds
Nine's
of
pretty early. I have a
daddy wants to
13
fly
and a
first
16.
class.
Honestly, my sense is when kids are really truly able to start having any meaningful conversation about money and the purpose of the capital and their role with it, that's honestly, that's probably even beyond high school. That's probably college. Maybe it's even beyond. Kids tend to be, at least in these circles where I am, all about getting to college, getting that degree, and then they think about some of this other stuff. But I would say, look, I think having money, it's not a bad thing. And it shouldn't be like hidden or not talked about in weird ways. I think that sometimes will create some weird feelings on behalf of the younger generation. Like, how come we can't talk about this or have a conversation? Meet the kids where they are. Maybe that's my final word.
To use another data point, I've seen a lot of clients like try and beat their kid's head when on this financial stuff when they just don't have money. They don't have a real job. Sometimes you can alienate them and do more bad than good in that situation. But Scott, thanks for jumping on. If you guys like these types of topics, check out his book, Building a Sustainable Family Office. Any other ways to get a hold of you?
Yeah, Lane, thank you so much. The book is on Amazon and other places, of course. So appreciate the opportunity. And I hope for all your listeners, this was helpful. LinkedIn, of course, people can reach out and connect.
Thanks, Scott. Appreciate it. Well, see you guys next time. So I've seen this from families that are between $5-10 million where they used to be an operator. So they have experience operating 200 unit, 300 unit apartment complexes. Although this kind of defies my whole, you never want to have more than 5-10% of your net worth into any one asset. In a way, these guys can defy the rules because they are operators, right? They're not passive investors. But what I'll see from these guys as they transition out of the operator seat and live off passive income is that they'll hire a firm like ours to asset manage for them. Or one individual who hires the property management, keeps them accountable through KPIs. That individual takes 10% of the income or a certain percentage of the bottom line. That way there's aligned interests and the owner of that apartment doesn't have to babysit. They're incentivized. That person, the asset manager, has skin in the game. So that's kind of one, if you have more of a hands-on type of operator. The other idea, this is why it's cool when I jump on these onboarding calls with you guys, like sometimes I'll talk to a guy who's $8-9-10 million and they're thinking the same way and they've already been investing in real estate in their 20s and 30s and also run a business. They're not in any of these groups that we mentioned, YPO, EO, Vistage, Tiger 21. I'm like, you guys got to get a part of a group like ours, like the Family Office Ohana Mastermind. Maybe you're done investing. Maybe $10 million net worth is good enough, but it's more about succession planning, getting your kids around the right people, as we discussed on today's podcast, and having the conversation such as, what are you doing? Are you having your kids ride coach when you go first class? What's the conversation like after? That and many other of those similar conversations happen when you start to up level. And unfortunately, you have to pay to play. The famous quote I hear a lot in these groups I'm in is, I'm paying to be around you and hang out with you guys. And that's just how the world works. If the price tag is too much, you probably don't deserve to be in the room. Hopefully this podcast was insightful. If you haven't yet, check out my book, The Wealth Elevator, where I diagram the stages of wealth building